So I'm going to talk to you about 3 things that every real estate investor needs to know, and this will apply whether you're doing small deals or big deals. Hey everybody, Greg Barron here. Thanks for joining our YouTube channel once again, The Professor of Real Estate. And today we're going to dive into some meaty stuff, so you're going to want to stay with us. The first thing I want to talk to you about is what factors affect capitalization rates. The second thing I'll talk about from investing is just what are good investment returns. The third thing I'm going to talk about is a term we call capital buckets. It's what are the expectations of returns for different capital buckets of assets. So the question I get asked often is just what factors go into determining a capitalization rate in the first place. So basically there are 6 factors that go into it. The first is the current interest rate structure. So let's think about it this way. It doesn't take much effort right now to determine if I have $100 to invest today, what vehicle could I put it in to earn what I call a risk-free rate of return. So as you can see from the graph that I've just pulled up, today's current risk-free rate on a 10-year Treasury is right at 3.975%. If I've got $1,000 to invest today, I know with certainty that I'm going to earn close to 4% on that. So reason says that interest rates affect cap rates going forward, and they've got to be higher than 4% on anything I'm looking at today. So any return I get has got to have a premium above that. That's number one in the capitalization mix that we want to measure. The second thing that affects cap rates are comparable sales, or comps as we call it in the industry. Anybody that's ever bought any kind of real estate, particularly if they've put any debt on it at all, has had to get an appraisal. This appraisal is going to give you comparables within the area, and normally those comps are going to be like properties that have sold within a certain time frame that produce X amount of value that you can compare your product with to something that's got a trailing history to. The third factor that affects the capitalization is the age of the property. Obviously, aged properties are going to be, we'll call it more seasoned. I like to be called more seasoned and not old. But those properties are going to have more wear and tear on them. They're going to have more maintenance issues unless they've had some kind of value add over the years. But property age is a very important factor in capitalization. In certain asset classes, you'll classify them as A, B, B minus, B plus, C, and some that are just plain dogs. But age is going to be an important factor that affects capitalization rates. The fourth thing in determining a capitalization rate is really the condition of the property. This goes along a lot of times with the age. This exposes a lot of hidden factors that, frankly, it's going to require a tremendous amount of due diligence in the buying process to do after you've determined whether it's a go or no-go. I'll give you a quick example. In the last few years, we were involved in an acquisition of a 24 property portfolio in about 12 states. After we determined that this acquisition was in the realm of probability, we took a microscope to the properties. And the most important things we did in this process were we started with the exterior envelope and worked our way in to determine the actual condition. We had a checklist, as we always do. The things that we look for from experience, frankly, some other people may not be able to discover. As a real estate investor, you don't want to get caught in the emotional trap of falling in love with something just because the numbers on the surface work out, because you could have a lot of hidden issues that are going to impact your returns in years to come. So you want to look at 4 or 5 significant things during your forensic exam that very well could uncover things that could affect your return in the years to come. As a rule, we always start with the exterior envelope. Those typically are those with the highest impact of costs. We start with the roof. Now, whether in an industrial facility where you've got, say, a single ply roof, or a multifamily where you've got 3 tabs, you really want to see when that roof was installed. In the case of most of these roofs, we'll have a third-party inspector come along behind us if it's of significant value, to have them give us a report of what useful life we think it will have in the future. We then start to go around the building envelope. We look at the structure. We want to look primarily at all the HVAC or rooftop or split system units to see when they were put into place. Has it had any modifications during the life? If it's reaching about 15 years, in most cases we know that it's got very few years left, and we need to factor that into the purchase price, or in many cases subtract those prices from the ultimate value. Then after we've done the envelope, the HVAC, and the grounds, we move inside to look at the interior finishes. Even in the case of finishes, we want to see what kind of life is left, because we could have a material impact in year 2, 3, or 4 if we hold it that long. The fifth thing we want to look at is if it's got any value add upside. Now this is for particular assets that we think we can come in and modify, increase rent, and increase ultimate value with a going out cap rate that's better than what we went in at. And the last thing is property location. One of the rules that's becoming really apparent right now, especially with the dynamics that are going on in cities, is we want to go to municipalities where they actually like our money. So I'll explain just a little bit what I'm talking about. In more and more municipalities, it's becoming more and more difficult to develop because of the impact of the fees that they're placing on developers. And a lot of investors that are in multifamily in cities like Washington, D.C., New York, Chicago, to name a few, are experiencing the tremendous headwinds that rent caps are placing on their ability for their properties to perform like they had originally anticipated. So it's extremely important for you to do your due diligence in municipalities to determine if they like your money. So the second thing I want to talk to you about is what are good returns. So I want to break it down into 3 specific areas. First off, what I look at is cash on cash. The second thing I look at is what is the equity multiple. And then the third thing I look at is what is the expected going out internal rate of return. These returns I'm going to show you, I'm going to center on the asset class of multifamily for the purpose of this particular video. As always, if you're enjoying the video, be sure and hit the like and subscribe so we'll keep pumping out more information to help you as investors. So you need to remember as an investor that return should also be aligned with the amount of risk that you're going to take on that particular asset. So with multifamily returns, we're going to have different cash-on-cash return expectations. If we look at something that's been seasoned, that's been in the market for a long time, it may need some value add to it to prop up the rent. We're going to have naturally more risk to it. So we're going to require more of a return, so it's going to be on the upper end. And my usual range is between 5 and 9%, depending upon all of those factors that go into what I previously talked about. What kind of risk am I going to take? On the other hand, if we're looking at something that's fully stabilized, it's fairly new, our expectations on the return could be trending toward the lower side because we have some history and we know we're not going to have a lot of upkeep. We can fairly predict what our escalations will be. However, it's been a little difficult lately because of property taxes and insurance. But our cash-on-cash return would be on the lower end of that spectrum. But they've all still got to be several hundred basis points above my risk-free market rate return that I could shove money into a treasury with at the end of the day. Thanks for joining us again today. Remember, educate, evaluate, so that you can ultimately execute to increase your own personal wealth. See you next time.